Hi, I'm Mark Hebner, President of Index Fund Advisors, and today I'd like to talk about the Spiva report recently released here in 2017. Spiva stands for the Standard & Poor's Index versus Active. And this report comes out a couple times a year, but there's something particularly special about this one in that we have now completed data from 2002 to 2016, a 15-year track record. Now, we're going to talk about this in a minute, but one of the most important parts of this study is it includes funds that went out of business. About 50% of the mutual funds that started along the way from 2002 to 2016 have gone out of business. 50. So this includes those dead mutual funds, as they're called. They're actually a combination of funds that went out of business and ones that merged with other funds. And we're going to talk about those charts in a little bit. But let's start by looking at the percentage of actively managed funds that beat their benchmark over this entire period. How about in the large cap growth area? 95% of the funds underperformed their benchmarks. What? 95%. Large cap core, 97% underperformed their benchmarks. Large cap value, 79%. Real estate, 82%. Small cap growth, whoa, 99% of funds over the 15 years underperformed their benchmarks. Small cap core, 95. Small cap value, 81. And these particular asset classes are ones that active managers like to describe as inefficient markets among those small caps, where you're better off finding that active manager who can ferret around, dig around, and find those small cap stocks that look like they're going to be mispriced or undervalued, whatever they want to call it. Guess what? They're not finding them. Not the case. When we look at all the asset classes combined here in the U.S., 82% on average underperformed their benchmarks. Not good odds. How about among international equity? Another area where active managers claim to have some advantage. They claim you have inefficient markets there. Well, let's see. International equity, 89% underperformed. Small cap equity, international, underperformed, 82. Emerging markets, often cited as the inefficient priced markets, 90% underperformed their benchmark. On average, among a whole bunch of different asset classes among international equities, 83% underperformed their benchmarks. How about fixed income? Same old story. Everything in the publicly traded markets are efficiently priced. Listen to Eugene Fama. He's been telling you that since 1965. Government long-term bonds, 97% underperformed their benchmarks. Government intermediate term, 82% underperformed. Government short-term, 86%. Look across here, they're all horrible. High yield, only 4% did better in their benchmark. Investment grade, long-term, only 3% did better than the benchmark. Now, part of the problem here has to do with the fact that when Spiva looks at this data, they consider the funds that did not survive, as I mentioned at the beginning. Look at these charts. This is the survivorship of each different asset class. Domestic large cap, 66% of funds went out of business or were merged, did not survive. Domestic small cap, 48% did not survive. International, 57% did not survive. Do the average, 51% were dead or merged. Now, they don't do that if the active manager is doing a great job. They would just keep him going along. By the way, there are no great active managers. There's only lucky active managers. We didn't even consider luck in this analysis. You'd have to go to another article or another paper, another video to understand the luck component of the winners. One more important subject is what's called style drift. This is the great thing about Spiva, is they look at all kinds of aspects of this analysis except for luck. Maybe they'll add that in the future. In the style drift area, what are we looking at? We're looking at funds that have a target asset class or style And when the funds were analyzed over long periods, the Spiva analysts had discovered that they drifted away from their stated mission in terms of style. Well, how bad? Well, in the domestic large cap, 61% had style drift. Domestic small cap, 54% style drift. International, 58. International small cap, 49. Emerging markets, 48. On average, when we look at all these different asset classes, 57% of them drifted from the stated style. Now imagine how hard it is to benchmark a mutual fund with a style or an index, and then the mutual fund is changing its style. That's why we have a whole step of the 12 steps dedicated to the style drifters. One last thing you might think of is, out of chance alone, what percentage of these managers would we expect to stay in the top 25% or top quartile of investment managers on a consistent basis over time? Well, when we looked at that data, first of all, we'd expect about 6.25% to stay in the top 25% over all these years. Turns out in the domestic large cap, only 0.8, small cap 0, small government funds 0, investment grade bond funds about 4%, high yield about 2%. And as you see here, those are far less than we would expect by chance alone, okay? Not a good study for the active manager. And the real lesson and the real takeaway here is stick with the index and forget about the active. Thanks for listening, and I hope you have a great day.